Hi, I'm David Stein, and in this video, I'm going to share how to invest in bank loans. Bank loans might not be an asset class that you are aware of. They're sometimes known as leveraged loans or floating rate loans, and they have some really unique characteristics. First, because the loans are variable rate, that means that as interest rates go up, the value of the loans don't go down. The loans are tied to short-term interest rates, and those interest rates on the loans reset every 30 to 90 days. Now, bank loans are obviously loans made by banks, but they're made to what are known as non-investment grade companies, so more speculative companies that are more likely to default. And as a result, I tend to invest in bank loans through an actively managed mutual fund where the manager can select several hundred bank loans to invest in. But you can also invest in bank loans through exchange-traded funds. Now, another interesting characteristic about bank loans is they're very senior in terms of if the company who borrowed the money goes into default, the bank loan issuer, whoever lent them the money, gets first dibs on the assets. And as a result, when a bank loan defaults, the recovery rate's been really high, 70 to 80%, so that the loss has only been about 20% instead of the 60% loss that you typically see with a non-investment grade or high yield bond. Now, there's been a lot of money going into bank loans so far in 2018 because as the Federal Reserve has been raising interest rates, traditional bonds have fallen in price. And again, we've seen that that's not the case with bank loans. But because there's such a high demand for bank loans, we're starting to see what's known as covenant-light structures. When a company borrows from a bank, they have to sign certain agreements or covenants. And what we're finding is those covenants are getting more laxed in the sense that if a company typically would default or perhaps not meet certain income thresholds or certain income levels, they could be put into default. But that definition of that income is becoming less restrictive. In other words, they might exclude certain expenses, might add back certain other one-time revenue. So about 80% of bank loans right now are of this covenant-light variety, and that's another thing to consider. Now, here's the biggest risk when it comes to bank loans. Certainly default is a risk, but it isn't just default. When I first began investing in bank loans in 2006, we put our clients into these. It was a relatively new asset class. But by the time 2008 came along, the price of bank loans began to fall. Even though interest rates were falling, bank loans were falling even more. And what I realized is, and I didn't know at the time, is that if investors believe the default rate is going to increase, then they're going to demand a higher interest rate for bank loans. And the only way they could get a higher interest rate is if the price falls. And so bank loans in 2008 lost over 28%. So right now they're yielding 5.6% before default. So your return's not going to be any better than that over the long term, probably a little less than that. But if we get into a slow economic period, the price of bank loans could fall significantly. Now, that spread, that incremental yield you got over short-term interest rates got as high as 15% in 2008. That was really, really rare. In 2016, that spread of the incremental yield got up to 7%, and that caused the price of bank loans to fall a couple percent in 2015. But then they gained 10% in 2016, and after that horrid 2008 year, they returned 50% the next year. And so we need to be mindful that right now, the incremental yield you get for bank loans above short-term interest rates is about 3%. If the economy appears to slow, that spread could balloon up to 5-6%, and if things got really bad, up to over 15% like they did in 2008. So we have to be really cognizant and aware when we invest in bank loans. It's nice to pick up that yield, but as soon as that default or as soon as the economy appears like it's going to slow, I am going to exit my bank loans, and you probably should too. But that's a short introduction to leveraged loans, floating rate loans, also known as bank loans. you have any questions, you can put them in the comments. And if you would, go ahead and subscribe to the Money for the Rest of Us channel. Thanks.